Hello YouTube, welcome to another Mango Method video. We're going to spend today talking about prepayments. It's one of those accruals that we want to look at. We have a general video around accruals, but this one is particularly focused on prepayments. We're going to look at the basic way that we can do it in the core financial model, and then we're going to look at a few deeper scenarios or a few other scenarios that require us to use potentially a customization that deals with some of the nuances of working with prepayments. And the same actually holds true for all other accruals, but purely dealing with prepayments in this instance. So let's dive into it. We've got the trusty core financial model here. Osma's on the company. We've got an empty file here. We just want to just work with this in isolation, just so we can kind of understand the flows of and how things work. Prepayments are, in case you're not aware, prepayments are payments that are made that deliver benefit over a long period, or a longer period, such as like 12 months, could be 24 or more. Very common in things like insurance, so prepaying business insurance, public liability, professional indemnity, basically things where you're paying an annual subscription or something for the benefit of the company that will last over many months, usually a year. And that's why insurance is a good example. So, and even just with something as simple as insurance, there's so many potential scenarios that could play out in modeling out insurance. So let's look at the basic example and how we would work that in the core financial model. So if we use a very simple example, and we have Osma's on, we're about to start the business, we need to buy some insurance. What do we need to think about? All right, early business, we just need a small quote, a quote for a light policy. It's for simplicity, let's say it's 12 grand a year per annum, covers us for a full year up to the revenue target that we're expecting. So let's purely focus on that. So on the P&L side, we've got ourselves set up here. Just before we get into it, for our reference and display to helpers, we've got the P&L showing, as well as the balance, the insurance on the P&L, and the prepayments on the balance sheet, just to give us a bit of a clue of what's happening as we key things in. So if we look at this, we've got ourselves our standard operating expenditure amounts. We've got other balance sheet item movements, and we've got those two ready to go because those are the ones we need to deal with prepayments. There's some nuances we'll talk to in a sec, but let's just put that example in. So we have 12 grand in insurance that we're buying. It's going to last a year. 12 divided by 12 to get to a monthly figure is 1,000 a month. So the recognition of that will occur over 12 months, and it's going to be $1,000. So if we just go 12 divided by 12, $1,000 a month, that's our P&L line item. And then if we go to our financials, you'll see that cash goes up, goes down, gets more negative because it assumes that we're paying for the insurance every month because we've only dealt with one side of the financials. Now, on the flip side, if we move the balance sheet account, so we need to make sure that we've got the balance sheet account ready. So give ourselves a balance sheet account mapping, and we need to take it off our prepayments section, which we'll get to shortly. Right now, we're just using the simpler approach. So in this example, we're going to do a recognition to balance off the assumption that we have above, and it's going to be a negative amount to reflect that it's a reduction in the balance sheet item over time. And what we find here is cash now goes to zero, or cash movements go to zero, because purely all we're dealing with is the recognition on the P&L and the fact that that recognition is now being used up, hence greater negative every month. Now, to finalize that, we need to actually make the payment. So right now there's no cash movement. Like if we go to our cash flow statement, we'll see there's no cash movement. So if we come back here and actually pay for the 12,000 in July, we'll find that the cash now goes to negative 12,000, and the prepayment is now reducing over time. Our cash flow reflects the 12,000. So in this example, we've now purchased the insurance in July, we've paid for it, and we're now recognizing it. So that's the base example. It's basic, it works very well, and this holds true for all sort of prepayments. If they're not sizable and your business is relative to the size of the rest of the expenditures for your business, or your bank account is probably a good measure, then it's sufficient to just do this. It just comes out in the wash as you go through your BAS cycle. It'll clear out, you'll get the refund. It's more of an issue if the expenditure item is actually quite large. Like, if we're talking 12 million, that's a significant sum. And not capturing things like GST for it, that'll be a big issue, because it's like 12 million, 10%, that's 1.2 million. So that's quite a sizable sum to not capture correctly. So if we now go to our customized approach, so like a full approach, so what we're going to do is we're going to stop our usage of the base content. So we'll just unmap everything. And now we actually delve into prepayments. So just before we do that, we're going to have a quick look. We've zeroed everything out. We need to align or allocate this prepayment so that this driver now relates to prepayments. And if we go into the actual same example, so 12,000 for the year. So in this case, the bill, so we're actually looking at it from the operational perspective. We would have received a bill from the insurance company for $12,000. So we would key that in, let's say it occurred in July, we got the bill in July. So you'll now see $12,000 goes in as a bill. Before we do anything, let's just reset everything. So we're going to zero our GST, no AP or AR, just so we can get to the same exact outputs that we had before. So again, if we jump into the P&L, now the difference you'll see is cash has occurred straight away, because this is the methodology that you deal with the billing. You allocate it to the balance sheet. So we've moved the balance sheet account by 12,000. There's no GST in this example yet. We'll put that in a sec, but we've moved the balance sheet item, and then we haven't dealt with the P&L yet. So in this section, we've got, you can see that the bottom just says recognition. So what we'd be doing is putting the recognition account items in here. So now we've got our P&L coming through with the 1,000 a month. We've got the cash flow as it was before going out. We now have our prepayments being recognized and brought down over time. And again, the cash flow statement says 12,000 in the month of July. So if we then take this another level and go, all right, well, the reality is we're going to be paying for GST. So let's start with the GST side. So no AP, so no timing delay, purely GST. You'll see all of a sudden we're now at 13,200 in negative cash. And you also see that delays over a bit of time. So this is the GST component that we pay. I deliberately made the example where the payment delay occurs and it carries, the GST payment delay or the GST reconciliation or BAS, keeping in mind this is Australia, it might be different in different countries, but the BAS component that deals with the GST refund or payment through the tax office is done quarterly in our example, quarterly 2 months after quarter end. So you'll see in this example, 13.2, or if we go to the cash flow statement, 12,000 goes out as the payment to the vendor. 1,200 is paid at the same time, but that's the GST component. So we've paid the supplier with GST. And what that then reflects is we're now owed. So it's a GST payable negative, so an asset. We're owed 1,200 in GST from the tax office, and that's just the standard returns process. So nothing else has changed. Recognition's the same on the prepayments. The expenses are the same. So now we're just dealing with the GST component. So as you can imagine, if this is now talking in the millions or relative to the size of your bank account, if that GST number is quite sizable, knowing that you'd receive 1,200 if your cash balance is relatively lower is a big thing, and it's a big thing to model these big lump sum payments that go out at a time. Yeah, you can see the nuance already that just by adding in this layer, we're dealing with the extra complexity of having GST on top. Next part, we're going to delve into the next layer. So, we've talked about GST, we've talked about the recognitions, we've talked about the basic example, but let's take that one step further where payment timings are factored in. So what we're going to do, we're going to leave our GST there, and we're going to look at this example where we now delay this payment. So before we do that, let's just do a quick recap. We've got cash going out in July, 13,200. It's made up of 12,000 from the payment to the insurance provider, as well as 1,200 in the GST. Now, we're going to delay that, and we're going to say insurance provider has given us, let's say, a month to pay it off. Bill arrives in the mail mid-July, and they've given us a month to pay it. So what we're going to do is we're going to go, all right, well, for the purpose of that, we need to delay that payment. So in the model, what we can do is just attach the insurance bill to an accounts payable profile. Let's have a quick look at the profile we're using. So if we have a look at our open accounts payable section, we've got our profile end of month +1. So if we examine that a bit further, our end of month +1 profile is 0 in the month of invoice or the month in question, and then the balance of payment occurs in the following month. So basically whatever billing we received in that month, at the end of the month, all payments will get cleared out within the next month. So that's the profile that we're showing here. So we've got a closing balance at the end of July. That's the bill plus the interest, so the 12,000 plus the 10%. In the next month, we've got 13,200 being paid, and that's the end of month plus the 1. So if we jump back onto our financials, what we see is cash in that period is 0. So we haven't paid the amount, so there's no movement. We'll see that in August, cash is now 13,200. So we have actually made the payment, and that's made a movement to cash. If we scroll down a bit and examine that, we'll see, so we'll talk about July in a sec, but we'll see in August, it's 13,200. So that payment of that bill has moved into the next month. Now, you'll see in here, there's an operating cash flow of 0, but there's some numbers here. So just to explain that, what we're saying, because this is done on an accruals basis, there's 1,200 in GST paid, because in that period that we received the bill, we've recognized the GST liability from an accruals perspective, in GST receivable from an accruals perspective. The actual cash payment timing is dealt with a bit differently, but you'll see that we now have a movement in the accounts. And then in order to balance that, and on top of that, we've also got liabilities going up by 13,200. So the differentials created are what creates this positive 1,200, because no cash has actually left the account in this period. It's just the fact that we've now accrued for the GST receivable. The AP is now also capturing that full outstanding, because the bill is still 12,000 plus the GST that we need to pay. So no cash is left. We're just splitting that into the GST component and the what's still left in accounts payable. We can do a bit of a split if we want to tidy this up, but let's not go into it. It's sort of a bit overkill trying to really tidy it up even further. So if we now look at the next month, so we've got 13.2 in payments. So what we're effectively saying is, yep, now in August, we are now able to make payment of the bill, of the insurance bill. So that's the next layer. That's now the delayed payment. So if we take this one final step further, at least from our video's perspective, there's also funding for this insurance. So what could also happen is we might actually just get this insurance funded. There's a lot of, and it's actually a commonplace scenario where premiums paid in advance, there are funding offerings that will fund that insurance for an interest cost over could be the full cycle, 12 months, or for over a shorter period. But there could be funding available for this. So what we're going to do, we're going to make that assumption. We've got a liability account here ready for us, insurance funding. We're going to use debt to pay that off. A couple options. We have our debt amounts and our debt payment profile. Now, I think we're going to use our payment profile because what often happens is you'll be provided the installment amounts that you need to pay the third-party insurance premium funder. And then what we need to do is we need to then draw down the amount. So we know that in August, that's when we pay for it. So we're going to need to draw down in August. Different insurance funders will be different. They may or may not cover the GST. For simplicity, we're just going to assume that the GST is included. So what we're going to do in August, we're going to draw down on the loan. So it's the 12,000 multiplied by 1.1, so allowing for GST. And we're going to draw it down. We've got our maturity date at the end of June. So we're assuming that the provider is giving us until 11 months until June. So that provides 1 month for the discussion. Just the specific scenario, we're going out to June. So if we now examine this on the financials, so what we quickly notice is 0 is still there. So that AP already remains. Now we have the insurance funding. So if we look at our cash flow statements, our payment still hasn't changed. We still paid that supplier or the insurance provider. We now have interest that we're now paying for. And on top of it, there's a net debt drawdown or a repayment. Now, just to quickly explain that, because that's a net amount. In this case, there is, if we look at these repayments should be the same for every month. So 1249, 1249, 1249, 1249, because it's a credit foncier or a single or a static installment payment with differing interest and principal components. So what's effectively the figure in here is the 13.2 with the 1249 less the interest component. So that's the principal reduction occurring in our net debt drawdown. Now that we've got that explained, the figure here, so the net cash flow of 1249, and actually that's probably a good example. The 1249 is the installment, as I've sort of shown, that we're now paying. So our cash, although we've got funding, we still need to make those installment repayments. So in this case, we've got the installment of 1249, and that is our negative cash balance. And if we look at the financials up the top, just to kind of give ourselves a bit of a sense check, we sum up all of our interest. That's 534 in interest that we've paid from taking on this insurance funding, this prepaid funding. And we look to the cash balance, which is 12,534. So that kind of gives us a bit of a sense check that over this cycle, we've in fact paid out 12,534, which is the funding of the insurance premium plus the GST. Remember, we get the GST funding back. So as we'll see in November, there's 1,200 that comes back from the GST component. So we get that back, but over the full cycle, interest of 534 was paid and 12,000 was the insurance premium. So the total net cash negative balance at the end of all of this is negative 12,534. So yeah, that's sort of another layer on prepayments. So if we kind of recap, so the prepayment is the P&L recognition side. So just recognize what's been taken up and what's been released. We have the balance sheet prepayment, so the initial prepayment that you've taken up and the release over time. One technicality is that insurance premium, depending on the period of recognition as well, that insurance might be covering you from the middle of the month to the middle of July, in fact. So we might need to make this 500 and this 500. All technical, all nuances, and depending how accurate you want to get, obviously that will need to be adjusted, but we're just keeping it simple. We just assume that the coverage period is the full July coverage period up until the full June. There's the recognition, there's the balance sheet movement. We've talked through the basic approach of building it into the model. So getting a recognition, getting a balance sheet movement to reflect the recognition, the net non-cash movement of the recognition, and the actual cash payment that occurs. Then taking it to the next level, we then go, okay, well, we actually need to ensure that we've covered for GST, depending on the amount, if it's material. So covered for GST, and on top of it, we've also catered for payment timings, because the insurance provider might provide us terms. And then the last bit is then also funding of that insurance. And third-party insurance provider is offering us a solution at 8%, and we might take that for cash flow purposes. So that allows us to then draw down on it. We now extend that 13.2 over time, and we've paid $534 for the benefit of being able to do that. But there's some basic insights and analysis. The question is that we can raise from this: was that worth it? Was the $500 or 8% that we've paid worth it? That's some of the analysis that needs to come from this. But that's how you create the cash flows. That's how you create the scenario of insurance in a basic core financial model, stepping it up into a customization, and then layering on top different financing of it. So hopefully that gave you a bit of insight. Next time you go to manage your insurance forecast or prepaid expense forecast, not just insurance, so software licenses. So if you pay for 12 months or even 36 months, similar concept. Your initial prepayment will occur here, and that figure might be divided by 36 and carried over 36 months. So the recognition occurs over 36 months. So key things to think about, and just key things to understand, that you're reflecting the P&L right, as well as reflecting the balance sheet correctly. And, in these cases, dealing with the nuances of like GST or AP timing. So yeah, hopefully that was insightful. Any other feedback, any other scenarios you'd love us to run, more than happy to take feedback and use it as the sort of catalyst for creating the next video. So, hopefully you've gotten something from this. Give us a like. If the content was useful to you, we'll be doing a lot more of this. Hit the subscribe button, and we'll see you in the next video. Thanks again.